So the August Consumer Sentiment Survey's just been released. The main takeaway, the RBA's decision to leave rates on hold for a second month in a row has done very little to lift what is still a very dark consumer mood. The Consumer Sentiment Index declined 0.4% in the August month to just 81. It's a very weak read by historical standards. It means that pessimists outnumber optimists by nearly 20%. And over the course of the survey week, the RBA's move led to lower sentiment reads rather than higher. Even the mortgage belt recorded a significant decline in sentiment, down 7%. Some of this seems to be due to doubts about how long this pause will last. We see this as the end of the tightening cycle, but for consumers they're much less convinced. About 2/3 of consumers expect interest rates to rise further over the next 12 months. A third are bracing for a rise of over 1 percentage point. So there's clearly doubts about the extent to which rates will stay on hold. This is about a similar mix that we saw back in April, even though since then we've had clearer signs of improvement around inflation. And we think from the RBA's commentary, a more confident view that rates will be on hold this time around. But it looks like that inflation surge, pressures on incomes are still the dominant factor for consumers, really weighing heavily on sentiment. The August month might have seen some higher profile price pressures re-emerge. We know that petrol pump prices rose 17 cents a litre month to month from the July survey to the August survey. Also, the latest round of electricity price rises would have gone through on July 1 for the benchmark. Increases are 20 to 25% for many of the major eastern seaboard states. So we've argued in the past that for consumer sentiment really to rise from here, we'll need to see much more convincing signs that inflation's easing, not just in the measures, but also in consumers' day-to-day lives, and that may not be happening just yet. There were some positives in the detail in August. Views on family finances improved slightly, and some of that looks to be due to the improvement in housing markets flowing through to some quarters. And the responses around the labour market did show improvement as well. And they still look to be, expectations around the labour market still look to be pretty well anchored. You're consistent with a cooling in the labour market rather than a sudden deterioration. Around housing, it's more of a mixed bag. We're still seeing this really acute tension between buyer sentiment and price expectations. Buyer sentiment remains deeply pessimistic. Price expectations, though, continue to move from strength to strength and are now very bullish. To us, that points to this really ratcheting effect and tension between affordability on the one hand, which is pretty bad already and deteriorating every time prices move higher, and this expectation that the momentum we're seeing in the market is now well established. This affordability issue is looking like becoming an increasing problem for consumers over the near term. That said, there do look to be maybe some fear of missing out effects flowing through into some markets. Those markets that have seen the biggest price increases, Sydney and Melbourne, actually saw buyer sentiment improve slightly. So there may be some more nuance to that picture. But in general, I think the main takeaway here, policy-wise, is that the RBA's decision to extend its pause, 2 months of rates on hold, hasn't seen a significant lift in sentiment. That's a bit of a double-edged sword. On the positive side, for the RBA's point of view, it doesn't suggest that spending is not about to suddenly bounce back, which would make it more difficult for them to achieve their inflation tasks. But for the consumer, it points to a continuation of this tightening in purse strings that we've seen over the last 9 months, continuing well into the back end of this year.